The next two papers will address a very related question, but will address it with very, very different methodology. And so if you think back to the introduction, I talked about this topic of, where does the government get in? How do we want to regulate, leverage? I mean, to the extent that sort of negative equity, in sort of Pascal's presentation, negative equity was, and also inability to pay were both sort of central to people's decision to default. Once you realize that, you then want to say, well, the government may want to enforce structures on mortgages to minimize the probabilities that down the road people are either unable to pay or end up in negative equity. So various dimensions of leverage, whether or not be loan to value ratios or debt to income ratios, etc., have been proposed, have been implemented in many ways. And so Anthony will discuss one of his papers where they look at a specific instance of leverage regulation in the United States, and we'll look at the impact that has on market equilibria. And then Matteo Benetton, who'll be the last presentation of today ahead of the panel, he'll talk about leverage regulation in the UK mortgage market. And so two different markets, but very related policies, and really trying to understand what happens in these markets when the government comes in and says, we're going to put in some restrictions on leverage. So thank you very much, Anthony, for joining us, for spending time. The floor is yours. Be looking forward to see your paper.
Great. Okay. So apologies. It sounds like those of you students in attendance did not get what looked like was supposed to be a 15-minute break, but I'll try to go easy on you. Okay. Great. So thanks, Johannes and Teresa, for inviting me to present this paper. Let me just make sure everything's on the right screen here. Excellent. Okay, great. Yeah, so thanks for inviting me to present the paper. So this is paper, it's a joint work with Stephanie Johnson, who was a PhD student at Northwestern at the time we wrote the paper. She's at Rice University now. And John Mondragon, who was a colleague of mine at Northwestern at the time we wrote the paper and is now at Federal Reserve Bank of San Francisco. So there's a disclaimer there. These are our opinions, not the Fed's. Good. So kind of as a starting point, just a kind of a jumping off point for this paper, we kind of like to motivate it with what is at this point a very well-known fact, but we think still important fact, which is just if you look at the patterns in household leverage over the last several decades, the period around the 2009 financial crisis stands out as quite a stark outlier. There was this huge run-up in household debt or measures of household leverage leading up to that crisis. So just showing you here, this is the ratio of total outstanding household debt relative to disposable income in each of those years. So that's kind of a stock-based measure of how much debt households have. But this pattern was kind of true no matter how you measure it. You could also look at this as just kind of the ratio of the payments that you're making on your debt relative to your income. There was also these large fluctuations in these measures of indebtedness. And these are patterns that we know, and kind of coming out of the financial crisis, there's also been a lot of work kind of showing that these patterns in household debt were not at all a sideshow to what was going on in that financial crisis. So in particular, a lot of evidence suggesting that the run-up in debt leading to the crisis played an important role in fueling the increase in house prices that eventually, in many ways, caused the crisis, as well as the high level of debt outstanding at the time that crisis hit, played an important role in kind of slowing the recovery from that crisis. So these are facts that we know. They're also facts that were not lost on policymakers at the time that all of this was going on. There was sort of a two-pronged policy response to this. The first is there was kind of in the immediate aftermath of the financial crisis, there was a host of what we would call ex-post policies put in place geared towards trying to relieve the existing debt that had already been accumulated. These are things like HAMP and HARP, which Pascal, who you saw in the last session, has a paper on. And so that was kind of one part of the policy response. But a second part of the response was also to sort of take a more forward-looking ex-ante perspective and say, hey, well, if we think that all this debt got us potentially in trouble, maybe there's a policy justification for limiting the amount of debt that households can take on up front. These types of ex-ante restrictions on leverage were typically motivated from one of two perspectives. Either it's good for the macro economy to keep the levels of household debt down, or even if there's kind of no macro spillovers from this, if households are behavioral or for whatever reason, getting themselves into debt that they for themselves is suboptimal, there's also just a pure kind of consumer protection angle to these types of policies. So there's been a lot of work done kind of measuring the effects of the number one there, these ex post policies. But I would argue, certainly when we wrote this paper, and I think even now, empirically, we're kind of in the dark on how those second sets of ex ante restrictions on leverage work. We know theoretically they might have some benefits, and we're starting to learn more about kind of empirically how they work. And so what we're trying to do in this paper, or what we were doing in this paper, was just try to come in and provide some early first pass evidence on how these policies affect, kind of in a relatively narrow sense, the specific markets that they're intended to regulate. And so we take a particular policy that was passed in the US, and we're going to study kind of the implications of that policy for the mortgage market in the US. The name of the policy we're going to look at, I'll describe it in more detail in a bit later, is called the Ability to Repay in Qualified Mortgage Rule. This was part of the Dodd-Frank Act, which is a kind of a legislative package passed to deal with some of the stuff that came up in the financial crisis. This was kind of the largest mortgage-related part of that legislation. And the way this is going to work, I'll describe it better later, but the way that you can think about this working is in a lot of ways, it's going to act as an implicit tax on lenders for originating mortgages that have certain risky contract characteristics. In particular, the debt to income ratio, meaning the ratio of the monthly mortgage payments to the household's monthly income. And the idea was to make it more expensive for lenders to originate these loans with the explicit aim of reducing the amount of this type of leverage that was out there. And so what we're going to try to do in this paper is just trace through the implications of this type of policy on that market, okay? We're basically going to ask three questions. One is, you could, as an implicit tax, you could think of this as kind of showing up in the market in several different ways. One obvious way you might see it is, well, if you tax lenders, they might just pass on the cost of that tax to the borrowers. And so borrowers might end up actually paying higher prices for these risky mortgages to compensate the lender. Alternatively, lenders might just decide to back away from this. It may no longer be worth it for them to originate these mortgages if they can't pass on that tax to the borrower. And so you might see this show up in the quantity of high-risk mortgages being originated. So we'll look at that on two dimensions, how many mortgages are being originated, as well as of the mortgages that are being originated, do you actually see these reductions in household leverage at the loan level? And then finally, at the end, we'll have something to say about the implications for a regulation like this for mortgage market performance, meaning default rates on mortgages. So let me give you just a high-level overview of the findings and then talk about how we get there. So we're going to find that on the price margin, this policy had a relatively small effect, although a very visible and sharp effect on prices, leading borrowers who take out these newly regulated mortgages to pay about a 10 to 15 basis point premium relative to what they otherwise would have, or about, over the life of the typical loan, about $1,700 to $2,600 extra dollars in interest payments. Okay, so that's going to show up, but we're going to view that as relatively small, particularly so in comparison to the size of the quantity effects that we're going to find. Okay, so of the segment of the mortgage market that's going to be newly regulated when this policy comes into place, we're going to find that about 15% of that portion of the market just completely disappears. Lenders no longer make these loans anymore. And then an additional 20% of that affected market ends up borrowers who would have otherwise gotten the highly leveraged loans end up taking out less leverage. Okay, so that's a quite large quantity response, in particular relative to this price effect we're finding, right? Because that suggests some lenders are willing to do this and they price this at only a 10 to 15 basis point premium, whereas other lenders just don't want to touch these mortgages at all. And so at the end, we'll also look a little bit at kind of heterogeneity across lenders, looking at who are the lenders that responded most to this. And there's going to be an important message there about the way that this policy was targeted and the institutional features of the US mortgage market that may have led to a policy like this having large quantity effects despite these small price effects. And then on the performance margin, we're going to find that we're going to show that the dimension of leverage that this policy regulated, this debt to income ratio, is just not all that predictive of mortgage default. And so, no matter how much you reduce the DTI in the region that we're looking at, it's not going to imply very large effects on aggregate mortgage default rates, reducing aggregate default rates by something like 0.2 percentage points, which is quite small relative to the double-digit default rates we saw in 09. Okay, so the bottom line here, kind of takeaway from this is it's going to be a message in some ways about targeting along two dimensions. One, targeting policies to the dimension of leverage that's most important to regulate, right? You could have imagined also regulating something like the loan to value ratio, or even measuring this debt to income ratio in a different way or in a time varying way. And then also targeting a policy to the institutional features of the market that you're being regulated. These large quantity effects were in many ways unintended by the regulator and show up and show up as a result of some features of this market that I'll talk about as I go through the results. Okay, so those are the results. Let me talk about how we get there. And that's going to take a little bit of overhead in describing what exactly this policy is. So let me do that first and then talk through some of these results. So like I said, the name of the policy we're going to be looking at is the ability to repay in qualified mortgage rule. This is a policy that came into effect in January of 2014. The Consumer Financial Protection Bureau was the regulator in charge of implementing this policy. And at a high level, what the policy did was essentially outlaw making loans to borrowers that the lender hasn't made what the law is going to call a reasonable good faith determination of the borrower's ability to repay that loan. So it's now illegal to make loans to borrowers that you know the borrower won't be able to repay. And in a lot of ways, this is where that implicit tax on the lender is going to come from. This is going to expose lenders to new legal liabilities they didn't face otherwise, because if a borrower ends up in default, they can just sue the lender and say, hey, you didn't verify that I was actually going to be able to pay this loan. And then the lender is responsible for paying back all of the borrower's interest payments as well as court fees, et cetera. So that's what this law does at a high level. But then the question becomes, well, how does a lender comply with this? What does it mean to make this reasonable good faith determination? And so the law is going to lay out basically two ways of complying with this new requirement. One is very vague, which is to just say you have to do this in a good faith way. And what does good faith mean? Well, at a minimum, it means you have to look at 8 things about the borrower, things like what is their income, how much debt do they have on their non-mortgage accounts, et cetera. But there's no explicit guidance in the law. You have to consider those things when you make a decision about whether or not to give the borrower a loan. But there's no explicit guidance in the law about what it means to consider that. You just have to factor them into your decision somehow. Okay, specifically, there's no limits necessarily on the type of mortgage you can originate. So that's a little bit vague, and the law intentionally makes this vague because they lay out another way of complying with this, which is just to originate mortgages that look a certain way. What's called a qualified mortgage, which is a loan that has a series of features that if your loan looks like this, the borrower will lose their ability to sue you under this new regulation, okay? And so that's where this tax comes from. If your loan has a characteristic that's not defined as a qualified mortgage, that characteristic is going to be, in some sense, taxed from the lender's perspective because you now face this risk that the borrower is going to sue you if that borrower can't, and if they end up in default. So it becomes very important for the lender, what does it mean to be a qualified mortgage? What is the definition of that? Well, the feature of the definition of a qualified mortgage that we're going to focus on, the most important one, the most contentious one at the time that this law was passed, was that if you're going to call your loan a qualified mortgage, the debt to income ratio has to be less than 43%. So that's where this regulation on leverage comes in. Okay. But importantly, at the time this law was passed, there was a large portion of the mortgage market that did not have to satisfy this debt to income requirement in order to be considered a qualified mortgage. Okay, so there was what's called a GSE loan, which is just a mortgage that can be insured by the US government, does not have to meet this debt to income limit in order to be considered qualified. And so what that's going to do is kind of carve out this market into kind of two spaces, right? There's these non-GSE loans that have to meet the DTI requirement, and these GSE loans that don't. And then there's loans that have high DTIs and low DTIs. And we're going to be able to use that segmentation of the market as a way of measuring the effects of this policy on prices and quantities. So just to be a little bit more specific about those questions, now the questions we're asking are, do lenders charge a premium for these non-QM loans, meaning loans with high debt to income ratios that are non-government insured? And then on the quantity margin, do we lose high DTI mortgages that were being originated prior to this? And of those mortgages that are still being originated, how much lower are the borrower's DTIs than they were before? And then finally, what's the effect of DTI on default? That's essentially the mortgage performance question we're asking. So to answer those questions, we're going to use standard data on loan level mortgage data from the US. So this is sort of rich data that gives you information on the performance of these loans over time, as well as the characteristics of the loan at the time it was originated. Most importantly, the debt to income ratio and the price of the mortgage for us. Okay, great. So let me talk through how we're going to answer each of these questions in order. And I'll start with the price question. And for each of these results, I'm just going to first show you the raw data. And then I'll kind of show you briefly how we tease the result out of those patterns in the raw data. So if you start with prices, I'm just going to do a very simple thing here. I'm going to take all of those non-GSE mortgages, what's called a jumbo mortgage, a loan that the government can't insure. And I'm just going to plot the raw interest rate at the time of origination for two different groups of these jumbo mortgages. The mortgages in the blue line here are mortgages with DTIs below 43%, for whom this policy will never be binding. The mortgages being plotted in the orange line are loans for whom, after January of 2014, the lender is going to face this implicit tax. And I'm just showing you the raw interest rates on those two groups of loans. That's plotted on the left axis. On the right axis, what I'm showing you is the difference between the orange line and the blue line for each month of origination. And so what you see is immediately when this law comes into effect, there's this gap that opens up in the price being charged for these high debt to income ratio mortgages relative to the lower debt to income ratio mortgages, suggesting that lenders are now they're passing through some of this implicit cost into the borrowers in the form of higher interest rate on the order of about 10 to 15 basis points, if you just look at the raw average rates. Okay, and so this suggests a research design where you do a difference in differences. I'm going to compare interest rates for mortgages above and below this 43% cutoff before and after the implementation of this policy. I won't show you the equations. I'll just show you kind of the bottom line results from this. What these numbers are saying, this 13 basis point number here is saying, what that's saying is just that these newly regulated mortgages are about 13 basis points more expensive from the perspective of the borrower after this policy change came into effect. And that 13 basis point gap stays basically constant regardless of kind of other characteristics of the loan that you might think be driving the price of these loans, okay? Suggesting that there was an effect of this regulation on mortgage pricing. How big was that effect? Well, not all that large in terms of basis points. 10 to 15 basis points isn't particularly large. If you look at the average loan size in our sample, if the borrower holds that loan for 5 years before refinancing, which is the typical length of a mortgage, that works out to about that $1,700 to $2,600 additional expense that I referenced. So not pocket change, but also not very big compared to the size of these mortgages. So the next question becomes then, well, if prices weren't responding that much, what was going on with quantities? And here again, I'm just going to start with the raw data and then show you how we actually estimate those numbers that I showed you to begin with. So let me show you the distribution of the debt to income ratio on mortgages originated in 2013, which was the year before this policy came into effect. And this is in that portion of the market that the policy is going to bind, the jumbo market. Okay, so each dot here is just a fraction of mortgages in a given debt to income ratio bucket. And this vertically dashed line is where the policy is going to become binding in the next year, in 2014. And so if you look at what happens between 2013 and 2014, it looks like after the law gets passed in 2014, there's a movement of loans from above this 43% debt to income threshold to just below it, suggesting that some borrowers are being forced to take out lower DTI mortgages than before. And there's also now a missing mass of loans above this region, suggesting that potentially some of these loans disappeared entirely and can't be accounted for by these extra loans that are just below that 43%. Okay, so what we do in the paper is try to come up with a way of actually measuring those quantities, that's a little bit more sophisticated than just using the 2013 distribution, right? We can't just say that what was going to happen in 2014 if the law wasn't passed is equal to what happened in 2013. We have to have a more kind of sophisticated guess than that. And so what we do is we try to build up to that using what we know happened in the data, okay? So said another way, what I want to know is this quantity here, the counterfactual number of jumbo loans, meaning mortgages in this segment of the market being regulated, that would have been originated in each DTI bin after the passage of the policy, had that policy not actually been passed, so in 2014. how can I get that number? I don't actually see that number in the data, but I'm going to build it up from what I can see, which is the actual number of jumbo mortgages originated in each of those bins in the post period. That's the orange line I just showed you in the last slide, as well as as well as the number of loans being originated in each DTI bin in the conforming market, which is the portion of the market that doesn't face this DTI requirement. Okay, so I see both of those quantities in 2014, and I also see their analogs in 2013. Particularly, this is the blue line I just showed you, and there's a comparison to that in this conforming market, which I did show you as well. Okay, so I'm going to build up to that counterfactual distribution by assuming essentially that what would have happened in this regulated portion of the market in the absence of the policy can be measured using what happened in the non-regulated portion of the market in the absence of in the presence of the policy. Okay, and there's basically 3 assumptions I need to make in order to make this kind of work. The first thing I need to assume is that that unregulated portion of the market looks exactly the same way in 2014 as it would have had the policy not been passed. That's basically saying this counterfactual number of loans is equal to what I observe in the data. If that's true, I can use that group as a control group. In addition, I also am going to assume that this regulation also doesn't affect the jumbo market at small loan amounts, right? If I prohibit you from getting a 43% DTI, that doesn't affect you from getting a 36%, which you would have anyway. And so the number of 36% DTI loans should stay the same, regardless of whether the policy gets passed. And once I assume those 2 things, if I'm willing to say that what would have happened in the conforming market or in the jumbo market, the regulated part of the market, is similar to what would have happened and what I see happen in the conforming market, I can build up to a counterfactual estimate of what would have happened in that regulated portion of the market. And so just as kind of a proof of concept, what we do is we show that this approach to building this counterfactual actually works in years when there was no policy change. So this is just showing you 2013, again, the year before the policy came into effect. The orange line is what we see in the data. The blue line is what we estimate would have happened between 2012 and 2013 using what we know happened in the other non-regulated segment of the market. And you see this works really well when there's no policy change, suggesting that it should work well for building a counterfactual in years when there is a policy change, specifically in 2014, which is what I'm showing you now on this slide. So what this slide is showing, the orange line is what I showed you before. That's the actual data, what happened in 2014. The blue line is our estimate of what would have happened in the absence of the policy. And these numbers I'm plotting on this, or showing you on this slide, this 0.2, what that's saying is that of the potentially affected segment of the market, meaning of the loans under the blue line above the 43% cutoff, 20% of those loans that we estimate would have otherwise been above that cutoff are instead here in this region below the cutoff. And this 0.15 is saying that an additional 15% of those loans can't be accounted for at all in this figure. They just completely disappear from the market. Okay, so that's that large quantity effect that I was referring to. And that's big compared to the 15 basis point price effect, okay? And I thought it was helpful, especially since this is a PhD class, for me to stop and just talk for a minute or two kind of about the sausage making process in this paper and kind of the process we went through as we were kind of having this paper revised. So when we first submitted this paper to the journal, this was all we had to say on quantities. We just kind of had this result that, oh, this quantity effect is really big, this price effect is really small. It's kind of an interesting result, but it's a little bit unsatisfying because you don't know why that's going on, right? Why is there such a large quantity effect? And that's something we kind of knew too and we're struggling with. And it's also something that kind of the editorial team at the journal was also very curious about, right? So these are a couple of quotes from a referee. I always appreciate it when my advisors show me their referee report. So here's kind of as a sense of the types of things that the referees cared about, right? This is our first referee saying they think that this is the most interesting result in our paper. And they want us to investigate reasons for this decline more systematically. Second referee had very similar feedback on this point, saying this effect on quantity is interesting, but without additional discussion, it's not clear what we learned from an academic point of view. Maybe interesting for the policymaker, but kind of conceptually, what's the economics here? It would be nice to know more. Referee 3 sort of gave us a free pass on this, or at least I couldn't find any quote that was pithy enough to include in the presentation, so I'll pass on them. And then referee 4 said the same thing. Who are the banks doing this, right? What's driving this? Why do some banks price this at only 10 basis point premium, whereas other banks don't want to originate this stuff at all? Okay, so when you've got 3 out of 4 referees telling you to do something, the editor's going to notice that. The editor's also going to say you have to do this several times in the same paragraph. You have to investigate the reasons for this. What's the mechanism? Please find the mechanism. It's crucial for the revision. So, a big part of our kind of process in this revision was sort of trying to dig into this to the extent that we could using the data that we have. We think this is interesting. It's also interesting from a policy perspective, not just kind of economically, why is this going on, but also from the policy perspective. The regulator did not expect this to happen, in part because it's difficult to reconcile with kind of standard frictionless view of credit markets, right? If I make it more expensive for the lender to originate these types of loans, the lender should be able to just pass on a good chunk of that cost to you as the borrower and not have to completely drop out of the market entirely. So the question remains then, why do some lenders exit the market entirely, whereas others are content just pricing this and making the borrower pay for it? And so one potential explanation for this, if you think about the way this law works, remember I said that the law gives you 2 ways to comply with it. Either you can make a reasonable good faith determination that the borrower is going to be able to pay, meaning just do your due diligence and document that the borrower can pay, don't give out crazy loans that they won't be able to pay back, or only give out these qualified mortgages. Well, the costs of complying with the law under that first method kind of vary a lot depending on the business model of the lender. And in particular, we're going to think about 2 different types of lenders. There's what I'm going to call a vertically integrated lender, who performs all of the documentation and does all of the underwriting in-house, meaning they decide whether or not to give you the loan. They also collect all of the information about you. And then they're just going to hold their loan on the balance sheet. So they're also directly exposed to your default risk. And so this type of lender bears the legal liability for complying with this regulation and also has full and direct control over that compliance process because they're the one collecting your information. They're the one that if you sue can just tell the court, like, hey, here's the paperwork. Look, these guys were definitely able to pay back this loan when we made this mortgage to them. So their case has no merit. Another type of lender, though, what I'm going to call, for lack of a better term, a fragmented lender, it's much more difficult for them to do this. This is a type of lender which is very common. They outsource this documentation effort and this underwriting to somebody else. Somebody else is going to make the decision about whether or not to give you the loan, and they're also going to collect all of your documentation. And then I, as the lender, am going to buy that loan from them, or essentially sort of pay them to originate the mortgage for me. And so that creates a conflict of interest because I, as the lender, face a good portion of this legal liability. If you sue, I'm on the line for paying back some of those legal costs. But I don't have control fully over whether or not I've correctly documented your ability to repay. And so you could look at what happens to the market shares of these 2 different types of lenders in that high DTI segment of the market after the policy comes into effect. And you see that in 2013, the share of these fragmented lenders across debt to income ratios was fairly constant, normalized to what they're doing in the 43% bin. Whereas in 2014, after the policy comes into effect, these fragmented lenders drop out essentially entirely from this market, and their market share is significantly lower than it was otherwise, suggesting that these are the lenders for whom this law is really costly, and they're going to drop out of the market, whereas the remaining lenders, the integrated guys, can afford to still be in there, and they'll extend you a loan and only charge you a 10 to 15 basis point premium for that, okay? And so that's kind of the result we were able to show about, in some sense, where is this quantity effect coming from, or at least one of the channels through which this quantity effect may be operating. Okay, but regardless, it's a big effect, which kind of in and of itself, we think is interesting, even separately from the precise channel. Okay, and then lastly, I think I have 5 minutes. Let me talk through kind of what we can say about the implications of a regulation like this for mortgage market performance, meaning default rates on mortgages. And here the paper is going to be on relatively less strong footing, but it's important to have something to try to say something about this. And so what we do here, the question is, would a regulation like this have helped to avoid the mortgage crisis had it been in effect in full force, say back in 2006, rather than being passed in 2014? And so how can we answer a question like that? Well, we're just going to do basically a back of the envelope calculation here. What we're going to say is, well, if we would have passed this law in 2006, let's assume it would have done the exact same thing to the debt to income distribution in the entire market as we see it do in this jumbo portion of the market where it binds in 2014. And let's also assume that the relationship between debt to income and default stays constant. So that I can tell you now, if I shift a mortgage from being above the 43% ratio to below, or I remove a mortgage entirely from the market that used to be above this 43% ratio, if I count up all the mortgages, then what would have happened to aggregate default rates? And that depends on two things. How many mortgages am I moving around? That's what I just showed you in the quantity results. And how important is it from the perspective of default rates is it to move mortgages around, right? And so what this plot is showing you is just a relationship between the debt to income ratio on the x-axis and the borrower's default probability on the y-axis. And what the regulation is doing is it's taking loans from above here and shifting them down here, or it's taking loans from above here and just moving them out of the plot entirely. Okay, so the slope of this line, as well as the number of loans being moved, can be used to come up with a very back of the envelope estimate of what would have happened to aggregate default rates if we had this thing in place back in 2006. And I won't kind of bore you with the details of how we do this back of the envelope calculation. I'll just give you kind of the high level result here. If you look at, say, the 2007 cohort of loans, and you shift around those DTIs along this relationship in the same way that happened in 2014, you do get a reduction in default rates, but it's very, very minimal. The aggregate reduction in default rates about 5 years after mortgage origination turns out to be about 0.2 percentage points, which that cohort of loans defaulted at upwards of 15, 20% of those loans defaulted after 5 years. And so that's a very, very small effect on default rates. Now, again, it's back of the envelope, but the size of that suggests that it would be quite difficult to get first order meaningful effects on individual loan level default rates simply by reducing the DTIs on those loans. Okay, so that's kind of the overview of the specific empirical findings in the paper. At a higher level, kind of what's this paper doing, right? We were kind of early movers in this literature looking at these ex-ante restrictions on household leverage. We provided new evidence on how the specific markets being regulated respond to restrictions like this. We find these small price effects, but large quantity effects. And in particular, large quantity effects driven by what looks like an agency friction related to the particular way that the US mortgage market is set up, suggesting a message about targeting. You really need to target these policies in a way that takes into account the institutional features of the markets being regulated. Otherwise, you may get these unintended effects. And then only moderate performance improvement, suggesting that on top of that, you should also make sure you're targeting the right level, right metric of leverage if your goal is to reduce default rates. Now, what's left to do? Plenty of other things. And kind of what are the limitations of this paper? There's several limitations of this paper that I think are important to keep in mind, especially for those of you thinking about doing other work in this area. One is there's a super big question that we just can't answer in this paper, right? Some of the motivation for policies like this are about aggregate quantities, right? What happens to aggregate default rates? We can say a little bit about that, but more importantly, what happens to things like aggregate unemployment, right? But a lot of the channels through which the literature argues that these defaults have effects on sort of employment is that the mortgage market has effects on economic cycles is through things like unemployment, and we just don't have the research designed to answer that in this paper. Similarly, we can't say too much about welfare or distributional effects of a policy like this because our data doesn't say too much about who the borrowers are. So there's some more recent work looking at who exactly is being moved in and out of the market in response to this, and is that what we would want? And can we start approaching even what the individual level welfare effects of a policy like this might be? And then lastly, I think another area of interest would be looking at the spillover effects of a regulation like this on non-mortgage markets as well, because if I restrict you from taking on too much mortgage debt, you may end up levering up in other portions of your balance sheet. But let me leave it there, and I'm happy to talk about more in the Q&A.
Fantastic, thank you, Anthony. So we'll have some sort of follow-up questions in the Q&A.